Hello everyone, myself Dr. S. Mohammad Nazir. This class I am going to teach you macroeconomics. In macroeconomics, national income aggregates. What is national income? National income or national product is defined as the money value of all final goods and services produced within the domestic territory of a country in an accounting year plus net factor income from abroad. Okay. So all goods and services produced in a country, that value plus net factor income from abroad is called national income. What is domestic income? Domestic income is the value of production within the domestic territory of a country. Okay. There are many different concepts of national income. Each has specific meaning, methods of measurement and use. A list of these 8 concepts of national income are: gross domestic product at market price, GDP at market price; GNP, gross national product at market price; NNP, net national product at market price; NDP MP, net domestic product at market price; NDP FC, net domestic product at factor cost; GDP FC, gross domestic product at factor cost; GNP FC, gross national product at factor cost; NNPFC, net national product at factor cost. These are the 8 concepts of national income. I already explained these concepts in my previous video. Please go through that. Simply, the value of output. Okay, the country is producing goods and services in a year. That is called the value of output. Minus intermediate consumption, we get GDP at market price. In the GDP at market price, we subtract the depreciation. Minus depreciation, we get net domestic product at the market price. Okay. In that net domestic product at market price, we subtract net indirect tax. Net indirect tax is nothing but indirect tax minus subsidy. We get net indirect tax. Okay. NDP MP, net domestic product at market price, we subtract this net indirect tax, we get NDPFC, net domestic product at factor cost. If we add net factor income from abroad in NDPFC, we get NNPFC, net national product at factor cost. This is the national income. The important notes in the national income concepts are: the basis of distinction between gross and net, GDP, gross domestic product, NDP, net domestic product, is depreciation or consumption of fixed capital. Gross means net plus depreciation. So gross is equals to net plus depreciation. Net is equals to gross minus depreciation. Okay. So in order to find out the net domestic product, okay, we have to subtract the depreciation in GDP. We get net. The basis of distinction between national and domestic, GDP, gross domestic product, GNP, gross national product. The difference is net factor income from abroad. So national, GNP, how we get the GNP? GNP is equals to GDP plus net factor income from abroad. So national is equals to domestic plus net factor income from abroad. Okay. And then the basics of distinction between the market price and factor cost. We already seen, no, GDP at market price, GDP at factor cost. The basis of distinction between the market price and factor cost is net indirect tax. Net indirect tax is nothing but indirect tax minus subsidy. Okay. For example, market price. So the market price is nothing but factor cost plus indirect tax minus subsidies. So in order to produce a commodity, okay, government is giving some subsidies. So we have to subtract the subsidy in that value. And then government is imposing tax, indirect tax. We have to include that indirect tax in that product. Then we get the market price. So market price is equals to factor cost plus net indirect tax. Net indirect tax is nothing but, in bracket, indirect tax minus subsidy. Or in order to get the factor cost is equals to, so GDP factor cost is equals to GDP market price minus net indirect tax. Okay, now to find out the factor cost, we have to subtract the net indirect tax from the GDP. We get GDP market price, we get GDP factor cost. This is national income classifications. Now I am going to explain the difference between net factor income from abroad and net exports. Net factor income from abroad refers to the difference between factor income earned by our national resident from rest of the world and factor income earned by the non-residents. Okay, it refers to the difference between factor income earned by our national resident from rest of the world and factor income earned by non-residents. Okay, suppose our Indian citizens established institutions or firm in foreign countries and earning income, we have to include it in our national income. So the foreign nationals, for example, Korean citizens are invested here. They are running the company, Hyundai company here. So the income of the Hyundai company, they will take it go out. So we have to subtract that. So we have to include our resident citizens' income inside. We have to subtract our non-citizens' income from our GDP. We get the net factor income. Okay. So net factor income from abroad is the difference between factor income earned by our normal resident from the rest of the world and the factor income earned by non-resident. Here, the net exports. It refers to the difference between exports and imports of goods and non-factor services related to domestic territory of the country. So it is the difference between exports and imports of goods. Okay. Now, the net factor income from abroad equals to factor income from abroad earned by normal resident minus factor income of non-resident of the domestic territory. Net export is equals to export minus imports. Net factor income from abroad is a part of national income. Okay, net export is a part of domestic income. The net factor income from abroad, the main components are net compensation of employees, net income from property and entrepreneurship, net retained earning of residence companies. Okay, these are included in the net factor income from abroad. This is the components of net factor income from abroad. The components of net exports are exports and imports of goods and exports imports of non-factor services. Okay, these are the difference between NFIA and net exports. Now I am going to teach you final goods and intermediate goods. Okay, what is intermediate goods? They are those goods which are used for further production. The goods used for further production or for resale in the same year. This is called intermediate goods. Examples: wheat purchased by a restaurant, cotton purchased by thread making mill, furniture purchased by furniture shop for resale, cloth purchased by manufacturer of ready-made garments. These are the examples of intermediate goods. The features of intermediate goods are: the value of intermediate goods is not added in national income. Okay, it is not added in national income to avoid the problem of double counting. These goods are not consumed by consumers. Okay, the intermediate goods are not consumed by consumers. The third feature, they remain within the production boundary. Okay, they remain within the production boundary. The production boundary is an imaginary line drawn around the production sector of an economy. Within the line, the firm purchase each other goods for further production. Okay, these are the features of intermediate goods. Now, final goods. The final goods are those goods which are used for final consumption and not meant for resale or production. Okay, which means for the final consumption. Examples: wheat, furniture, cloth, bread, butter used by the consumers. Machines used by producers. Government services are also treated as final good in national income accounting. Okay, this is the final goods. The features of final goods are the value of final goods included in the calculation of national income. The value of final goods included in the calculation of national income. Final goods are consumed by consumers, called consumption goods, or used as investment by producers, called capital goods. They remain outside the production boundary. This is called final goods. So, if we get the idea about the final goods, intermediate goods, okay, we can easily understand the concepts of national income calculating. Now I am going to explain the difference between intermediate goods and the final goods. The intermediate goods, they are used for production of other goods and services. Final goods, they are used for final consumption. They are meant for resale, so value gets added of these goods. They are not meant for resale, so no value is added to these goods. Okay, they remain within the production boundary. They remain outside the production boundary. Their value is not included in the national income. The intermediate goods value is not included in national income. The final goods value is included in national income. The examples: milk used in a sweet shop for resale. The milk is used in sweet shop for resale. It is the intermediate goods. Milk bought by household for consumption is called the final goods. These are the difference between intermediate goods and the final goods. Now I am going to explain the consumption goods and the capital goods. Consumption goods, they are those goods which are bought by consumers as final or ultimate goods to satisfy their wants directly. They include durable goods like car, television, radio, etc. Non-durable goods and services like fruit, oil, milk, vegetables, services of doctor, teacher, etc. Semi-durable goods such as crockery, okay, cooker and kitchenware, that is called crockery. These are semi-durable goods. Services like bank officers, doctors, teachers, etc. Okay, these are all called consumption goods. What is the reason we are studying different types of different kinds of goods? So in order to calculate the national income, it is very easy to understand the concept. That is the reason we are studying different types of goods. Now capital goods. They are those final goods which form the capital stock of a country at the end of an accounting year, and which are used up in the production process. These included durable goods like a car purchased by a firm for use in business. This is durable goods. Stock of raw materials, semi-finished and finished goods at the end of an accounting year. Such goods satisfy the human wants indirectly. These are called capital goods. Now I am going to explain the private income, personal income and personal disposable income. Net domestic product at factor cost. Domestic factor income is generated in two sectors, private sector and government sector. Income from domestic product from government sector has two components: income from property and entrepreneurship to government. Okay, and then saving of non-departmental government enterprises. Income from net domestic product from private sector has three components: compensation of employees. Okay. Number 2, operating surplus. Number 3, mixed income of self-employed. If net factor income from abroad and interest on national debt and current transfer are added to income of NDP going to private sector. Private income is obtained. In order to obtain the private income, the net factor income from abroad, interest on capital, interest on national debt and the current transfer added to income from net domestic product going to private sector, we obtained the private income. If corporation tax and undistributed profits, corporation tax and undistributed profits are deducted from private income, we obtained personal income. If direct professional tax and miscellaneous receipts of government administrative departments are deducted from personal income, we obtained the personal disposable income. These are the four related aggregates of national income. It can be graphically explained in detail. This diagram shows how related aggregates are calculated from one another. Net domestic product at factor cost. Okay, it is included in income from net domestic product acquiring to private sector plus income from net domestic product acquiring to government sector. If we add these two sectors income, we get the net domestic product at a factor cost. How the private sector is getting income? The compensation of employees, that is salary, operating surplus plus mixed income. These three gives the private sector's income. The property and entrepreneurial income of departmental enterprises plus saving of non-departmental enterprises. If we add, we get the government sector income. Here, if we add compensation employees plus operating surplus plus mixed income, if we add net factor income from abroad, interest on national debt plus current transfers from rest of the world plus current transfer from the government, we get the private income. If we subtract the corporation tax and undistributed profit or corporate saving, we obtained the personal income. If we subtract direct professional tax plus miscellaneous receipts of the government administrative departments, we obtained the personal disposable income. So personal disposable income is household consumption plus household saving. Okay. Now private income. Private income is the income which acquires to the private sectors from all sources. Okay, that is private income. Now I am going to explain the difference between national income and private income. National income includes only factor incomes earned. Private income includes factor incomes and transfer payments. Okay, in national income calculation, we are excluding the transfer payments. Here, the national income includes only factor incomes. Private income includes factor income plus transfer payments. National income includes income generated both in private and public sector. Private income includes all types of income received by households and private enterprises in the private sector. Okay. National income is the income of normal resident of your country. Income of normal resident of your country. Okay. Here, it is the income of private sector from all sources. Okay. Interest on national debt is not included in the national income. Interest on national debt is not included in the national income. Interest on national debt is included in private income. National income is equals to net domestic factor income. Net domestic factor income plus net factor income from abroad. Private income is equals to net domestic factor income plus income from domestic product acquiring to public sector plus all current transfers incomes plus net factor income from abroad plus interest on national debt. These are the differences between national income and private income. Now I am going to explain personal income. Personal income is the sum total of income actually received by a person from all sources including factor income and transfer income. I repeat, It is the sum total of income actually received by a person from all sources, including factor income and transfer income. Now I am going to explain the difference between the private income and personal income. Private income is a broader concept which relates to total income of both the private enterprises and the household. Personal income is a narrow concept which relates to income received by the household or individuals. Private income includes the corporation tax and the undistributed profit. Personal income does not include corporation tax and the undistributed profit. If corporation tax plus corporation saving equals to 0, then private income is equals to personal income. This is an important concept. If the corporation tax plus corporation saving is equals to 0, then the private income is equals to personal income. I'm going to explain the difference between personal income and national income. Personal income relates to receipt of income. National income relates to generation of income. It is an earning concept. Personal income includes factor incomes and transfer incomes. Okay, personal incomes and transfer incomes included. In national income includes only the factor incomes, not including the transfer incomes. Personal income includes interest on national debt. Interest on national debt is not included in the national income. Interest on national debt included in the personal income. Corporation tax and corporate savings are not included in the personal income. Okay, the corporation tax and the corporate savings are included in the national income. Income from domestic product acquiring to the government sector is not included in it. Income from domestic product acquiring to the government sector is included in it in the national income. These are the differences between personal income and the national income. Now I am going to explain the disposable income. Disposable income is that part of personal income which is either spent on consumption or saved by the households. Okay. Personal income is equals to personal disposable income when personal tax plus miscellaneous receipts of the government is 0. When the personal tax and the miscellaneous receipt of the government is 0, the personal income is equals to personal disposable income. Now, the difference between the personal income and the disposable income. It is a broader concept which includes the all income actually received by persons from all sources. That is the personal income. Disposable income. It is a narrow concept which refers to personal income remaining with the persons after deducting direct tax and other fees and payments. After paying the tax, remaining amount is disposable income. All the sources of income is called personal income. Okay, here the personal income includes direct taxes. Here excludes the direct taxes. Okay, these are the concepts of personal income, personal disposable income, private income, everything. What is the reason we are studying this and all? In order to calculate the national income, if we are aware of these concepts, then only we can understand or we can calculate the national income correctly. Thank you.